Good evening. Hello and welcome to tonight's special virtual program, Charitable Planned Giving Mechanisms, presented by the Hoover Presidential Foundation. I'd like to also welcome our friends in Dubuque who are joining us through the Carnegie Stout Public Library. I'm Jerry Flegel, President and CEO of the Hoover Presidential Foundation. Tonight's program outlines how planned giving can benefit you and your loved ones and the causes you care about, whether it be a public library or a presidential one, or any nonprofit you'd like to support in your estate planning. This program is not a sales pitch. We won't ask you to buy anything. We are here tonight to show you how some ways to best leverage your charitable gifts and present some ideas you may not have known were available. Our speaker also has an informative brochure we'll send you free of charge at your request. You may email your request to me at info@hooverpdf.org and we'll get it to you soon. I'll share that email again with you at the end of the presentation. Please feel free to ask all of your questions tonight through the Q&A button on your screen. You may also like questions others have asked that may be similar to yours. We try to answer questions with the most likes first. We're recording this program and we'll post it to the Hoover Presidential Foundation YouTube channel tomorrow. We'll send you a link to the recording as well as a reminder about upcoming programs in a couple of days. Again, I thank you for joining us for this special program. With that being said, it is my pleasure to introduce tonight's presenter, Iowa City Attorney Bob Downer. Bob joined Meardon, Sueppel, and Downer in 1963 and is a University of Iowa graduate and University of Iowa Law School graduate. He is a recognized leader in his profession. Bob was co-chair of the Probate, Property, and Trust Law Committee of the Iowa State Bar Association for 3 years and chair of its successor committee, the Probate and Trust Law Section, for 2 years. He is a fellow of American College of Trust and Estate Counsel since 1993 and Iowa chair from 2000 to 2005. I know Bob from his efforts as a Hoover Presidential Foundation trustee, where he served on the board for 20 years, holding terms as vice president and president of that board. Bob, thank you for joining us tonight and sharing your knowledge of charitable planned giving mechanisms.
Thank you, Jerry, for that very generous introduction. I might say that one of the things that I had the opportunity to do as a member of the Hoover Board of Trustees was to designate a new chief executive officer some years ago. And Jerry, you've made all of us who were on that committee look good through your extraordinary efforts on behalf of the foundation. And I know that you have a lot of ideas that are going to be coming to the fore in the near future. One thing somewhat related to this also that I was thinking of as preparing for this presentation is that we've just been through a very bruising and somewhat divisive election campaign. And my thoughts went back to a number of years ago when Elie Wiesel, the Nobel laureate, spoke at a human rights symposium at the University of Iowa. And the point that he made in that presentation that stuck with me was that there had never been a country in recorded history that had the dedication to supporting charitable endeavors that was the case with Americans. And so while many people tend to somewhat denigrate our country, there are a great many things that we can be very proud of. And I think Mr. Wiesel highlighted one of those, and fortunately, I think that's a trend that has continued to this day and will continue into the future. One of the things, most of the things that I'm going to be talking about here this evening are ways in which you can leverage your charitable desires in making contributions to organizations that you support in a manner that will not only help the organization, but will help you achieve your goals, which in many cases are in the form of reducing one's tax burden. Certainly, charitable contributions in most cases do relieve a burden from the taxpayers in various types of endeavors, and that is the reason why these are favored in the Internal Revenue Code and why tax deductions are permitted. The charitable contributions should not be referred to as a tax loophole, but rather as a tax incentive to stimulate persons' charitable endeavors and to cause them to perhaps dig a little deeper into their resources to support worthy causes. These donations can take a great many forms, as most of you know, and probably the leading one is just writing a check, making a cash contribution. And there is certainly nothing wrong with that. It's simple. It's something that creates an immediate benefit for the charity, as opposed to something that may only come to fruition some years into the future. And it permits a tax deduction for the tax return for the year in which that donation is made. One of the things that is of somewhat lesser significance than it has been in the past are charitable bequests under wills or trust agreements, in part because the federal estate tax exemption has increased greatly. When I started in the practice of law, which sometimes seems like centuries ago, the estate tax exemption was $60,000. It is now approximately $11.5 million and can be doubled by providing for a surviving spouse if the deceased person has a surviving spouse. So I'm not going to spend a lot of time talking about that today, because I don't think that many people are in the position where that's particularly relevant. A lot of people wish they were in that position, but unfortunately that's not the case. A lot of what I'm going to be talking about deals with gifts of property of various sorts, and how it is important to identify items of property that can be good for purposes of charitable gifts and can get the greatest possible tax benefit for the person making the donation. In talking about gifts of property, there are essentially two types of property that are categorized. One is called ordinary income property, and the other is capital gain property. Ordinary income property, for most purposes, is not a good asset to be gifted. That consists of such things as inventory that a business might have, livestock that has been raised that does not have a tax basis for it, and items that have been owned for a period of 1 year or less. Capital gain property, on the other hand, is an asset where the sale of that asset at fair market value would result in long-term capital gain. So that means that there has to be a holding period of that particular asset for more than 1 year. And the amount of the deduction that you get is the fair market value of the gift at the time that it is made. So that, for example, if you buy a stock that because of stock splits, stock dividends, and various forms of corporate reorganization may have grown numerous times the original investment, you can get a deduction for a charitable contribution of that stock at the fair market value at the time that you made the gift. I know, for example, of one stock that some friends of mine and I were fortunate enough to buy some years ago, where because of stock splits, our tax basis in this is now less than $1 a share. It's currently selling for over $40 a share. So that if this was to be used as a charitable gift, there would be a deduction based upon the $40 per share fair market value of that stock, and the holders of stocks such as that, when they're gifted, are not subject to a capital gains tax on the gain over and above the original purchase price. There are some limitations on this, that you can only utilize up to 30% of your adjusted gross income in deducting for gifts of stock of that type, but you do have the opportunity to carry forward the unused tax deduction, the unused charitable deduction for a period of up to 5 years, so that you do have that period of time in which to use this up. Now, if you are making other charitable deductions in that 5-year period, if you're carrying forward the deduction, the amount that you contribute in that future year is used first, rather than a so-called first in, first out basis, so that you have to be careful in structuring those gifts so that the entire amount that is carried forward would be used up in a 5-year period. But if that is done, the tax benefits from doing that can be quite significant. Now, there are a couple of other restrictions that are applicable to this. Certain types of charities, you are only able to deduct 30% of adjusted gross income in making the deductions for the year in which the gift is made, and in those carry forward years. Most charities, however, allow up to 50% to be used per year, so that you do have an opportunity to use that fairly quickly in most cases. With the securities that are held for less than a year, you are limited in a deduction to the amount that was paid for that security. So as I mentioned earlier, that is not typically a good asset to use for this purpose. You have to be very careful in making charitable gifts that you have of property, that you have an asset that qualifies for a deduction. There is a restriction on partial interest gifts, so that except where there is specific language in the Internal Revenue Code that allows this, you cannot make a partial interest gift in a property. If, for example, you want to reserve income from a property for a period of time, you have to be very careful to structure that in a way that meets the requirements of the Internal Revenue Code. Now, there are more liberal rules associated with this if one is making a gift of a personal residence or of a farm. And if you give a fractional interest in the entire property, as opposed to splitting the right to the income and then eventual succession to the property in what's called a remainder, if you give a fractional interest in the total property, that qualifies for the deduction. These gifts have to be irrevocable. Once you have parted with the property, it has to be out of your ownership in total, and it's not possible to retain certain powers with respect to the future direction or management of that property, or things of that nature. There are some rather complex rules as to how the deduction of properties when properties of that nature are gifted, how the tax treatment occurs, and that's something that should be calculated quite carefully before making the gift. One of the other opportunities for charitable giving that has application to a lot of people is what's called a charitable gift annuity. As I mentioned in my introductory remarks, federal estate tax deductions are not something that most people have an opportunity to utilize at this point. At the same time, there are a great many people that I have worked with who want to retain the assets that they have because of the income that the property generates. They may be retired persons or others who don't want to limit their standard of living by giving away their current income, but have charitable inclinations that would be fulfilled at the time of their death. And a charitable gift annuity is something that I think fits for a great many people who have those desires and concerns. A charitable gift annuity is a contract under which a charity, after receiving a transfer of cash, marketable securities, or some other asset given to the charity, agrees that they will pay to the donor of that property a return over a period of time for the remainder of that person's life, so that typically, in my experience, this is expressed as a percentage of the value of the gift that is made, and that the donor in that way gets an immediate tax deduction and doesn't have to wait until the time of death, where in all likelihood that deduction wouldn't do him or her much good because of the current estate tax environment. So when there is an annuity of this sort that is negotiated between the charity and the donor, there is a factor based upon the donor's life expectancy as to what the amount of the actual charitable gift is. That's also governed by the interest rate that the donor would be receiving on the annuity. So the lower the interest rate, the higher the tax deduction that the donor will be receiving in the year that the gift occurs. And the annuity can not be assignable other than to the charity who has negotiated the annuity with the donor. And when the investment in the annuity contract has been fully recovered, payments received are taxable as ordinary income, so that if one is fortunate enough to live a long life and in effect outlives the annuity, the receipts that occur after life expectancy has been exceeded, those are subject to ordinary income tax. Conversely, if the annuitant dies before fully recovering that investment, that person's estate I need to back up a second. On the final income tax return for the deceased person, the partial year that would be taxed in the year of that person's death, the unused portion of that investment is subject to an income tax deduction. So this is something that I think in a lot of situations with persons of estates of a size that they don't have to worry about federal estate tax, this can be made to work very successfully. Now, a variant of that is that if, say, someone at age 55 decides they want to do something for the charity but are not planning to retire until 62, say, they could negotiate a deferred payment annuity so that the payments would not start for a period of 7 years until age 62 was attained. This would provide for a greater income in retirement, would not require them to receive income during high earning years before retirement. And so that is one that under certain circumstances would be very beneficial to people. There are both what are called charitable lead trusts and charitable remainder trusts. Charitable lead trusts in an appropriate circumstance can be very valuable. They are very tax effective in the present environment because of the fact that interest rates are so low, and the way that the such devices are structured can give a substantial tax benefit. In my experience, charitable remainder trusts have been of more benefit to people because of the fact that in most cases, again, in my experience, people are interested in preserving the income, but want to see the charity benefit after the owner has passed away. So with a charitable remainder trust, some years ago, the Internal Revenue Code was substantially restructured so that you could not just say in a charitable trust, I reserve the income for my life, and upon my death, whatever is left goes to XYZ charity. These have to be structured as what's called a charitable remainder unit trust or a charitable remainder annuity trust. And the difference between those two, and this is somewhat of an oversimplification, but the annuity trust provides a fixed rate of return for the donor of the property that will be constant throughout the period of time that the income is being paid to the donor prior to the donor's death. So the amount of assets that are subject to this annuity trust are not revalued at any time after the creation. So that if you happen to guess right and do an annuity trust at a time immediately before there's a collapse in the market, which a client of mine did back in early 2008 before the economic distress that occurred in that year. There's a very good return that can be obtained, and likewise a good tax deduction for that. A charitable remainder unit trust, on the other hand, has to provide for an annual revaluation of the assets that are subject to the trust, so that the income that is received by the donor of the property who has retained the income interest, that will fluctuate based upon a specified percentage of the value of the trust. And the distribution from a charitable remainder trust cannot be less than 5% of the value of the trust assets, valued either at inception in the case of the annuity trust or subject to the annual revaluation in the case of the unit trust. You cannot do a hybrid of these two kinds of trusts. Now, there is nothing that restricts you to just one such trust, and I know a number of people who have created multiple trusts, typically in different years, as they've had the ability to establish these kinds of charitable vehicles. So you could do an annuity trust one year and a unit trust at a different time. If you fund a charitable remainder trust with assets that don't have a readily ascertainable market value, such as publicly traded securities, time certificates, assets of that nature, you have to have them valued by a qualified appraiser. In the case of the annuity trust, you would only have to have that done once when you set up the trust. With the unit trust, you'd have to have an annual valuation of those assets to meet the unit trust rules. You can have beneficiaries of a charitable remainder trust other than an individual. I've not personally seen that done, but a trust could establish one and be a beneficiary or a partnership or some other entity of that nature. The rules don't permit you to designate a pet as a permissible income beneficiary because, not surprisingly, they've determined that pets are not persons, although I've known a number of people who seem to think that they are. You can, with a charitable remainder trust, substitute different charities if the trust so permits, so that so long as it's a bona fide charity, there can be changes in the charitable remainder beneficiary, so long as that's something that is permitted under the trust agreement. There are, because of the fluctuation in values of assets, typically not all of the distributions that come out of the trust are treated just as income. They may, in some cases, be paying out principal if the value of the trust assets, in the case of an annuity trust, has fallen below the rate that has been provided in the trust agreement. And so there is the income comes out first, but if that's less than what is required to be distributed to the income beneficiary, there are other tax treatments that are given to other benefits that are payable out to the beneficiaries. One other difference between a charitable remainder unit trust and a charitable remainder annuity trust is that with a unitrust, you can add assets to that trust, and the percentages that have to be paid out each year would be applied to the total assets, both the original trust principal plus any additions that are made to it. You can't do that with an annuity trust. That can only be funded at its inception, although as I mentioned a few minutes ago, it is possible to create a second or more charitable remainder annuity trust. The annuity that is received has to be for the lifetime of the person who has been the one at the inception of that trust, on whose life expectancy the annuity is valued. You cannot have as a measuring life the life of another person, so that the person who is receiving the income has to be the one on whom the life expectancy is calculated for determining the payments and the tax effect of this. However, you can create these so that they can be based on two lives. Typically, this would be a husband and wife, so that the income stream would continue after the first spouse had died, but the tax deduction will be lower on that because of the fact that in calculating the life expectancies of two persons, this is a longer period of time than it would be for only one. With charitable remainder unitrusts, there can be multiple beneficiaries, but at least one has to be a non-charitable beneficiary who is living at the time the trust is created. A unitrust can be made for a term of years if that is desired. If that's done, it is cannot exceed 20 years, although there is no problem with having this based upon the life expectancy of the person who is receiving the income payments, even though that person's life is longer than 20 years. There are a number of other rules that are applicable to both charitable remainder unitrusts and charitable remainder annuity trust, and the charitable remainder at the inception cannot be less than 10%. So that if this was someone who had an extremely long life expectancy, this probably would not work if the charitable remainder was less than 10% of the value of the assets at that point in time. One of the things that has become of some interest in recent years has been distributions from individual retirement accounts. And since 2006, it has been possible to make qualified charitable contributions of amounts from an IRA of up to $100,000 per taxpayer year without paying tax on the qualified charitable distribution. At first blush, a lot of people would think, well, how is that beneficial? Because if I take the IRA distribution, I include that in income, I write a check for the same amount to my favorite charity, so this offsets, and the making of the distribution from the IRA to the charity isn't really of any benefit. Well, maybe yes, maybe no. And there are a couple of circumstances, at least, where the making of the charitable contribution through the IRA distribution would be beneficial. One is that if the individual recipient is subject to the 3.8% net investment income tax, distribution from the IRA directly to the charity will save that tax. The other part of this is if this is a person who does not itemize deductions and makes the charitable contributions through the IRA distributions, that taxpayer can claim the standard deduction with respect to the his or her income tax, and still make substantial charitable contributions through directing the IRA distributions to the charities. So this is something that works quite effectively for a number of people. And another factor in that is that keeping gross income down can be helpful to persons who perhaps have significant medical expenses, so that keeping adjusted gross income at the lowest possible level will be helpful in terms of them getting over the threshold for deduction of those medical expenses. So it's something to be carefully looked at if someone is of an age where they can take the IRA distributions and are charitably inclined with respect to doing that. Another gift that can be effectively utilized in a lot of cases is a gift of life insurance. Many people acquire life insurance when they're younger because they want to be sure that there are funds there to raise and educate their children and support a spouse. As they get older, the need for the life insurance sometimes decreases. A number of people, in my experience over the years, have purchased this in order to pay federal estate taxes and other obligations that might be accelerated by their deaths. But they manage to retire that indebtedness, don't have the federal estate tax concern, so that the life insurance is no longer of a concern. Um, in the event that you want to donate a policy that is not fully paid up, and there are still premium payments on it, the donor can deduct the premium payments. They do have to be paid to the charity, and the charity then make the payments to the insurance company. They also, the owner of that policy, typically the insured, has to part with every ownership right that he or she may possess with respect to the policy. The IRS has ruled that even that one power that can be retained is the power to substitute beneficiaries, so that if there's a change of heart as to whether, as to what charity the former owner of the policy wants to favor, that has been ruled to be acceptable. In some states, there is a problem potentially with whether a charity has an insurable interest in an individual. In Iowa, that's not a problem, so that we don't have to worry about that in terms of charitable gifts of life insurance in Iowa. Upon the transfer of the policy, not talking about the subsequent premium payments on this, but just the transfer of the base policy itself, the donor gets an income tax deduction for the lesser of the fair market value of the policy at the time of the transfer, or the donor's cost basis in the policy, which would be typically the amount of premiums that have been paid on that policy. And if there were dividends that were taxable and that were retained by the insurance company, that would also augment the tax basis in that policy. I had mentioned that the premiums should be paid to the charity rather than paid by the former owner of the policy to the insurance company, in order to get the deduction of up to 50% of adjusted gross income for the charitable contribution. That has to be, the charity has to make the payments to the insurance company rather than the donor. At this point, Jerry, I think I'll take a break, and if there are any questions, or if there are any areas that you want me to explore further, I'll have to do that. I'll be happy to do that, but those were the basic things that I wanted to cover this evening.
Well, Bob, a lot of great information there. And one thing I always enjoy about listening to you is I always pick up 2 or 3 different new things, and it's like, oh, I hadn't thought about that. So maybe, and we got a few minutes left for questions. So if anybody has any questions for Bob, you want to just put them in the Q&A, and I'll be sure and ask them. And like I said, we get several. Make sure you vote for one similar, and because we'll take those in order. But Bob, maybe I might start off with first is when you're doing a lot of planning with your clients, what, maybe is there any one thing, and I realize all clients have different situations, but is there any one charitable giving way that just commonly gets overlooked that you can always tell people, well, you really should think about this, or I call almost gets them the most bang for the buck?
That's a hard question to answer because there are so many different situations. As I mentioned at the inception of the program this evening, what I typically try to do is to see if there are assets that the people have that they're not attached to particularly, where they can avoid potential capital gain at some point in the future. One thing, for example, that I have used a few times is that if someone has some very low basis stock that they have perhaps an emotional attachment to, if they want to do something that will increase the basis of that stock, and perhaps because of fluctuation in their incomes, having a stock sale in one year would be much better than another, they could donate this low basis stock, and 31 days or more longer in the future after that, they could replace the stock, and the only thing they'd have to be concerned about is the market fluctuation. But if they thought that perhaps this was a company that was going to be going through a cash out merger or something in the future at a point where they'd be better able to deal with the tax effects of that, they could plan for that and aid a charity at the same time.
Very good. Yeah, appreciable stocks or any kind of asset are always a great one to donate on with that tax basis. One question that I would ask Bob is, with IRA distributions, the tax law changed I think in 2017, where it used to be if you gifted or like that IRA distributions or went through an estate, they went for the term of the life of whoever they gave them to, and now it's limited to 10 years. How has that maybe affected how people might look at doing charitable IRA distributions?
This is the result of the Secure Act, which was, some people think it's not appropriately named perhaps, but regardless of that, this was a bill that was floating around Congress for a number of years, and suddenly it developed legs and got passed right at the end of the year. Where that has the biggest effect, in my experience, is that when someone dies with an IRA, if that IRA had been set up properly prior to the effective date of the Secure Act, you could extend out the payments to the beneficiary for the beneficiary's life expectancy. And if you had multiple beneficiaries, so long as they had separate accounts, if one wanted to take cash, that beneficiary could do it. If another one wanted to stretch it over his or her lifetime, they could do that. Now, the option for separate accounts is still there, but the time limit is a period of 10 years, except where there are specific beneficiaries, including a surviving spouse, there are some gotchas in that bill also. For example, there's an exception for a minor child. But once the minor child reaches what's probably the age of 18, it's not really clear what the age of majority is under that statute, then the 10-year period kicks in. So it does, it seems to me, create some incentives for using this for charitable purposes and perhaps not passing along IRAs as a significant asset to one's descendants because of the fact that they're going to have to take it over a shorter period of time. And if those people happen to be in a high income tax bracket themselves, the beneficiaries, there's really no way that they can extend that to the degree that formerly was the case.
Okay, very good. Well, one thing that I changed, I think, with the tax law this year, and I think it might be just for this year, is something about the 30% adjusted gross income. The level was lifted, so forth like that. Could you maybe explain or expound upon that a little bit?
Yes, one thing that the required minimum distribution requirements were suspended for 2020, so that if someone doesn't want to take a required minimum distribution from either an IRA or another type of qualified retirement plan, they don't have to do it this year. And with a number of people that I've worked with who count on these payments for income but still don't want to pay the tax, what we've done, they've typically taken the distribution in December so that they would get the tax-free buildup on these assets as long as they could. They're shifting that to early January so that they get the funds at roughly the same time, but extend out the taxability for a year.
Okay, well, very good. Well, very good. Well, we're running up against close to 7 o'clock hour, so I think it's, I'll probably go ahead and close it out on there. Again, thank you, Bob, for sharing this great information tonight. And of course, I'd like to remind all that, we've recorded this program and we'll send you a link once we process the video. And Bob has also provided a detailed brochure about charitable plan giving mechanisms that we'll send to you at no charge. Just email us at info@hooverpf.org. That's info@hooverpf.org to get your copy. I'd also like to remind everyone to join us for our regular Third Thursday program coming up on November 19th at 6 p.m. And for you Laura Ingalls Wilder fans, this is just for you. This month, historian Sarah Uthoff will portray Laura Ingalls Wilder in Around the Next Bend in the Road, the life of Laura Ingalls Wilder. Watch as Laura recalls her life journeys and composes the very first article that she ever wrote. This is also a free program, but advanced registration is required. And of course, you can register online at our website at hooverpresidentialfoundation.org. Again, thank you so much for Bob. Great job, great information, and thank you to everyone who has attended. And we look forward to seeing you when we get the Presidential Library back open. Again, thanks and great evening.